So welcome everyone. We're going to get started. My name is Elizabeth Aloni and I'm with Schneps Media. Schneps Media is the largest media company in New York City. We publish over 70 newspapers, magazines, websites, webinars, podcasts, and events throughout Queens, Brooklyn, the Bronx, Manhattan, Westchester, Long Island, and Philadelphia. Today, we're thrilled to bring to you this special webinar on learn how to take advantage of the historic low interest rates with the Queen of Mortgages, Lauren Cornea. Hi, Lauren. Thanks so much for joining us.
Thank you so much for having me.
Absolutely. So please tell us a little bit about yourself and the work that you do.
So I'm born and bred in New York. I've been working real estate for the past 15 years, and I've done everything from sales, leasing, commercial, residential, land, you name it. But what I really love the most is the financial side. I truly enjoy putting files together, going through an application, analyzing a client scenario, and creatively structuring deals so that way we can best help them.
Fantastic, fantastic. So what do these historic low interest rates mean to individuals?
Opportunity. It's a wonderful opportunity for people to buy, an opportunity for them to sell and possibly upgrade. And you can even invest. You can take cash out based on the equity in your home and then utilize that for a business venture. Maybe you want to do upgrades to your home, which would increase the value of your home. So it really is an opportunity for everyone to enhance their lives.
So what does refinancing cash out mean?
Great question. So refinancing cash out means that you're actually reducing the rate, but then you're also taking out money against the equity of the home. Typically, you're allowed a certain loan to value. So for instance, if your house, and I'm just picking a number out of the sky, is, and I'm going to pick a flat number, $100,000, and you owe $40,000 on it, that's a 40% loan to ratio. So that means if we're allowing up to 80%, that means you have an additional $40,000 up to $80,000 that you can cash out.
So when you say cash out, literally get the cash?
Yeah. So you can reduce the rate. For instance, let's say right now you're paying 4.5% and we can get you a rate of 3%. You can reduce the rate from 4.5 to 3 and actually get cashed out based on that value of the home.
Wow, that's like a win-win. It's like a double whammy.
Exactly. And so many people don't even know that this program exists. And it's such a wonderful opportunity that you can utilize, like I said, to invest in a new business, or if you want to, renovate your home, or even just have cash during these hard times when people are really unsure of, am I going to have a job tomorrow? Is there going to be another lockdown? So it's just really nice to have that money on the side that, oh, and here's another thing too, is when you pay back the money, you're paying it back at that same 3% low rate, which is cheaper than if you were to go and get a loan from the bank.
Wow. So it's a lot of benefits to that. And you can really create a safety net for yourself.
Yep.
Which is critical, particularly now, for sure.
Exactly.
So I've heard a lot of the conversation, and I'm not an expert like you are, mortgages, but I've heard the terms like forbearance and deferment. What are the difference between these?
That's another great question. So these are very loaded questions in the sense that it depends on the type of loan. It could be VA, FHA, if it's conventional, conforming, high cost jumbo. So I'm going to keep it very basic just so people get an understanding of the main difference between forbearance and deferment without going too much into detail. And if people do have questions in regard to their specific program, they can always contact me later and we can go into specifics. So the general idea of forbearance is in relation to COVID-19 assistance is so you can pause your monthly payments for up to 12 months. Now, this is something you have to actually find out if you're eligible for, and you would contact your loan servicer or the bank who's handling your loan. And then they would then find out if you're eligible, and then you would actually be able to pause your payments for a certain period of time. And then at the end of that forbearance period, there's different ways that you can repay it back. You can either pay it back in full, you can do a payment plan, or you can even defer it. And that's where the deferment comes in. Deferment means that they actually attach it to the end of the life of the loan. But you have to go through the forbearance period in order to qualify for the deferment. And obviously, they're going to do it based on your financial situation, and they're going to look into the financial hardship that you're incurring.
So that can be a real lifesaver to individuals who are going through a rough time right now. And to even, I think even knowing that that's a possibility
Yeah.
gives me some peace of mind,
Yeah.
when owning a home. Absolutely.
No, of course. So, the way it affects you is that it gives you the relief, so you can catch up financially in other areas, because you know that, okay, I don't have to worry about my mortgage payment right now. And you're also not concerned that you're going to go into default, which could then result in a foreclosure. So you're avoiding a lot of bigger problems that can snowball.
Fantastic. That's really important to know.
Yep.
So, there's so much activity in real estate right now. So many, which is a surprise, right? Nobody thought create a boom in real estate, but so many people are looking to buy. And what I've been hearing is that there's competition, and that there's multiple offers, and so when you're thinking of being a buyer, why should you be prepared to get a pre-approval on a mortgage?
Absolutely. You should not even start house hunting until you have a pre-approval. And the reason being is most times people don't even realize that they could probably qualify for more than they think. People just assume that, oh, I can only afford this much. But when we pre-qualify you, we go through your credit, we go through your income, and we can actually let you know, hey, this is your buying power. And then that gives you the confidence that when you're house shopping, you can afford that property that you're looking at, and you're also not wasting your time. Why do you want to look at a house that might be, unattainable, or something that, is lower than what you really could get? So in that sense, you don't want to even start the process without getting that pre-approval letter.
That's good to know. And how does it help you, once you start house hunting? How does that pre-approval help?
So sellers will take you more seriously. When you come to the table with that pre-approval letter from a financial institution that says, hey, we've looked at this person's file, and they can get a house up to X amount, it makes them take you more seriously. And if you're in a situation with a bidding war, then you definitely want to say, hey, look, I'm ready, willing, and able to come through on my offer. If you don't have that, they might, go with the next guy who does.
That's a good point. You want to really put all your ducks in a row so that you're in the best position to be able to,
of course,
have that house become your home.
Of course.
Is it a lot? So what are the things that people need to provide for a pre-approval?
The basic stuff. We would need a driver's license or a state ID or a passport, some sort of form of identification. We would run your credit. And a lot of people get scared, like, no, don't run my credit. It's going to hurt my credit. But, that's why we have credit, so we can buy cars and we can buy houses. So it's okay if it takes a 10-point hit. That's the whole point of it. That's why we work so hard to get good credit. You're not building your credit so you can get a Gap card. You're building your credit so you can buy a home. So we are going to run your credit, and that way we can get an idea of your payment history, how much debt you have, student loans, how many cars, do you pay late often, because these are all things that are going to affect how the bank looks at you. And of course the score, because the score will help determine what programs you qualify for. Then we're going to look at your W-2s if you're a salary employee. Typically it's the last 2 years. If you're self-employed, we're going to look at your last 2 years business tax returns and your last 2 years personal tax returns. In addition, we're going to need your last 2 months, or actually last 30 days pay stubs. and your last 2 months of bank statements. If you're doing a refinance and you're coming to us for a loan, we would ask for your most recent mortgage statement, just so that way we can see how much is left on the debt, what the rate is you're currently paying, whether or not you escrow your taxes and insurance, and see who your current servicer is.
Got it. So you get all those kind of ducks in a row, so to speak, with all that information, and then that allows you to be able to go and get the mortgage at the best possible rate.
Exactly. Exactly.
So, there are a lot of people out there that are renting and, haven't made the leap to ownership and are unsure if it really makes sense. You talk about how, it does.
It does.
So tell us, why should someone own versus continuing to rent?
Well, I think the biggest thing is to build equity. It's also something that you can borrow from in the future, as we mentioned before with the cash-out refinance. Renters are technically paying someone else's mortgage, when you think about it. Or they're just profiting. So why give someone else your hard-earned money when you can put that money into a property, and then that property will give you value that you can borrow against in the future? You're also planting roots. There's no risk of having to move unexpectedly because the house gets sold or they're going to knock it down or something of that nature. And it's so much more affordable than people think. There's actually programs out there, such as the Federal Housing Administration, where they give you low down payment amounts, like 3.5%. So a lot of times people think, oh, I need 10% down, I need 20% down. No, if you qualify, and there's a list of different conditions that we use in order to find out if someone would be eligible, you can put as little as 3.5% down. And that house that you thought you could never have is suddenly well within reach.
So what would be some of those things that they look at? Because that's really a game changer when it comes.
They look at income, they look at credit, and again, it's very involved. So it's better if I look at each individual case, and then we can figure out whether or not they would be eligible.
Wonderful, wonderful. So with all of these different things, it sounds like there's so much to think about before you buy a home or before you refinance, that, getting a mortgage banker is something that you really want to do in the beginning of the process.
Of course.
Share with us a little bit about the benefit of having not only, a relationship with a mortgage banker when you're buying a house, but why should you should you have an ongoing relationship with a mortgage banker?
Absolutely. So the benefits of having a relationship with a mortgage banker is, we'll give you a heads up, if rates drop, because we'll know your situation, so if we know that, okay, your interest rate right now is 5%, then, when it hits 3, we're gonna be like, hey, you should refinance, we could do this for you. We can do that for you. We can also keep you informed of new programs, that come out, such as if you wanted to do a renovation to your home, you could do a renovation loan. So, in addition, we also have a large network of connections. We know tons of contractors, realtors, attorneys, title companies, so we can just help you in that sense as well. So I always like to maintain long-term relationships with all my clients, because I feel like we provide so much more than just the loan, that in the future we can, just be of assistance to them and continue to help them manage their finances. We're more of like an advisor in that sense.
I really didn't know that about a mortgage banker, that, they can really help you even beyond, it's not just one and done, that it's really an ongoing relationship that can support you. And also, I think the referrals is so valuable because, so many of us, we will ask a friend or we'll, go online, but that's not really a tremendous amount of confidence that you can place in that.
Yeah.
So able to talk, have you to lean on and say, what do you think of this real estate attorney? Or, these are individuals that you have an ongoing relationship with. So again, that's not even something that I thought about one could turn to their mortgage banker for, but it makes a lot of sense. And being able to put together a team.
Yeah, exactly. You can have your own team of professionals. So that way, you can feel confident and know that, all right, I have what I need in order to, build my future and protect my family.
Absolutely. Do you tend to work with similar people? Like, do you have like a, your kind of go-to lawyer that you recommend, or, go-to people? Because I was wondering if, it's helpful to kind of work with a mortgage banker that has those relationships to be able to just have things move smoother.
Yeah, of course. The rule of thumb is to always recommend three. So I have 3 attorneys, 3 title people, 3, realtors, 3 construction professionals, 3 electricians. And the reason being is because it's always a fit of personality. So I'll provide 3 names to a potential, to a client, and then they'll have to do their own due diligence and interview those 3 names and then figure out who they like best, who gave them the rate that they're more comfortable with. And then that way the decision is inevitably theirs. It's also a protection in my case, because it could be a liability if someone thinks that I'm forcing them to work with someone. As a compliance, we can never force someone to work with anyone. So, it's more of a recommendation, and then you make the final decision as to who you like. And then that way, it kind of removes me from any liability, but anyone I give is always someone that we've done a lot of work with, and we know has a lot of experience. And then from there, like I said, it's just a matter of figuring out rates and personalities.
You really empower your clients, you give them advice, but then you really empower them to make that decision, which is important.
It's better because they're actually then educating themselves. They're not blindly taking a name and then just kind of saying, oh, well, okay, she told me to, so I guess I should. It's more of like, okay, person A, tell me your process and tell me what you think. Okay, person B, tell me your processes. And during that, they're actually educating themselves. So like you said, it's definitely empowering.
That's a really great point. And also, what you said too is about the connection. Like, how do you feel working with that individual? I think, that's also a big piece of it, is that, do you feel comfortable, being able to talk to that person and disclose financial information to that person, and be able to have a good, a good working relationship.
Yep. And it's actually funny you bring that up. A lot of people don't realize that mortgage loan officers like myself, we're fingerprinted. We are background check on federal and state levels. So we actually have been more scrutinized than the person who takes your information when you apply for American Express.
That's good to know. That definitely makes people feel a little bit more comfortable.
Yep.
That's great information. So I have a few questions from the attendees I'd love to ask you.
Sure.
We have one question. If you refinance, does that mean that a new mortgage bank is in charge of your mortgage?
So yes, thank you for your question for starters. And second of all, yes, it's going to be a brand new loan. And then typically what happens is the loan does get sold on the secondary market through Fannie Mae and Freddie Mac, which is how financial institutions keep their pipeline open, so that way they can continue to finance new loans. So if Family First Funding does your loan, which we are a mortgage bank, and so we actually fund our own loans, after we complete and close and so forth, we then sell the loan, and then it gets serviced by another mortgage company, by a servicer.
Okay. Now, another question is, what exactly is the process when you have a loan with a bank and then it's sold to another bank?
That's between the secondary market. That has no effect on you. It's not going to change your rate, change your term. The way the loan is written and the way the loan is closed is the way it will stay. And then the reason why they do that, again, is because it keeps the pipeline open for financial institutions to continue to lend. Fannie Mae and Freddie Mac, the secondary market, are federally backed home mortgage corporations that purchase loans. And so that's also goes into a whole other animal of like conforming loans and conventional loans and, what the different loan limits are and so forth. And so they purchase them, and then it's not something that affects you in any way.
Okay, that's good to know. Renee wanted to know, she said, good morning. Can I refinance a VA mortgage with a fixed rate? Anything under 3.5%?
I would have to take a look at your file. I would request that you send me your mortgage statement, and then that way I can see the current terms, the rate, the conditions, and see how much time you have left on it, because sometimes it's not worth refinancing. If you only have a few years left on the loan, then I might tell you, based on the amount of money for closing costs and so forth, it might not be worth it to you. There are programs that you can get for 30-year, 25-year, 20-year, and 15-year, and maybe even 10-year, but it depends on where you're at now. So without me seeing your file, it would be remiss of me to answer that question.
I think it's a really good point that you're making too, is that each mortgage and each situation is so unique.
Yeah.
Again, why it's so important to really sit down with a mortgage banker and go through your specifics.
Exactly.
General information is great, but when you're really ready to either refinance or you're ready to plan to buy a home or sell a home, that's really when you should start sitting down and kind of going through your details.
Yeah, absolutely. And, again, our evaluations are free. So if you want to send me your mortgage statement, I'll take a look at it, and we'll put as much time into it in order to figure out, what plan is right for you. And that's my favorite part. That's what I love. In fact, I just recently had a client who owns a 2-family in Ridgewood, and it was considered a high cost loan, which is right out of the conforming limits. It doesn't mean that it's impossible. It just means that the rates are typically higher because it's a high cost, higher rate. So this is where the creativity part comes in. What we decided to do was we piggybacked the refinance with a HELOC, and we are using the HELOC, which is a home equity line of credit based on the value of the home. And we're utilizing the cash that she's going to receive from the HELOC in order to pay down the mortgage. And then the mortgage is going to now be in a conforming rate and a conforming loan range. And then now that it's in the conforming loan range, I can offer her a lower rate. So we're going from 4.5, we reduce it to 3, and she's actually reducing it even more because she's going to buy down the rate to 2.875, which is another thing that everyone should keep in the back of their mind whenever you're purchasing or refinancing. If they give you a rate, ask them, is there an option for a buy down? Maybe, for a couple $1,000s, you can actually go from a 3% to a 2.875. So sometimes it's worth it, because when you look at the length of the loan on a 30-year loan, that eighth of a point could add up well over the amount you would pay to get to that point, to get to 2.875. And if I'm being confusing, I apologize.
No, that's really, really clear and really exciting. I mean, obviously, if people have questions, I did put your name, your number, your email address in the chat. And I'll also include it in the email that will go out to everybody as a thank you. But I think, you make a really good point that it's not so straightforward.
It's not.
It's not just, oh, I want to get a mortgage, or, oh, I want to refinance. What's the best rate? Thank you. Goodbye. It really is, how can I figure out the best way for me to use my money to be able to have the end result.
And also, what's the best for each file, because that's the difference between a mortgage banker like myself, working for Family First Funding, is that we really have a hands-on approach that you're not going to get with your, electronic loan depot or your Rocket Mortgage. You're just another application in their system, or even a broker. Brokers don't have the type of flexibility that a banker does, because, since we're financing our own loans, we just have a lot more, programs and creativity in that sense. So yeah, I mean, each file is different, but we always put the best effort into each file to make sure that the client is walking away happy. And if there's ever a time when we say, we feel that we can't help them, we'll just be honest and be like, hey, listen, you're good. There's no reason to refinance. There's no reason to do this. You're good. We're not going to do it just to, get the commission. If it doesn't make sense, then the closing costs are going to outweigh, the benefit. We'll tell you that.
That's important. That's important. So we have another question. Rini, I think that's how you pronounce, sorry if I'm mispronouncing your name, wants to know, is the cash that is taken out of a loan and immediately, or does it immediately have payments required to be made? They think that you addressed it, but it went by fast and they kind of missed what the end.
Sure. That's actually a great question, because I didn't finish that thought. So when you do a refinance cash out, the amount of cash taken out gets tacked onto the loan amount, and it gets paid back as part of your monthly payment at the same low rate as the refinance. So you're not even going to feel it. It's not a separate payment.
I'm on mute, sorry about that. We had a couple of questions about that, so I'm glad that we were able to just address that. I have another question from David, who wants to know, what do you think of a 10-1 IO? Okay, this is a lot of numbers. So what do you think of a 10-1 IO, 3.125%, 75% LTV on a $1 million condo for a 73-year-old?
Okay, so he's asking about, so a 10-1, so he's asking about an adjustable rate mortgage. IO is interest only, 3.125 is the rate, and you're talking about LTV is your loan to value, which is 75% of $1 million, which would be 750,000. And based on your income,
the queen of mortgages.
Based on your income, we would be able to determine whether or not you would be eligible for that program.
Great, thank you.
But I would say that, if you could get 3.125 on $1 million condo, God bless you, because that's considered a jumbo. So jumbo rates are typically higher. So if you can get that, go for it.
Nice. Here's another question. When one is asset adequate but has no earned income, what is the scenario? I'm retired for many years.
Do they have pension? I mean, most people. So again, we would have to see their situation. I mean, there's typically some sort of income that people receive, whether it's from their pension, if they have a 401k or an account that they regularly draft from each month. So without seeing the person's full situation, it's really hard for me to answer that. But I would love to help you if you want to contact me.
Okay, great. And we do have that contact there. And they said no pension.
Oh, no pension. Okay, sorry, I didn't hear that.
No, they just said it now. Social Security investments have IRAs.
Okay. So I mean, yeah, so you definitely have, reserves, you have, but again, without me seeing the entire file, it's hard for me to make a determination. Okay. We would have to run credit. I would have to see the IRAs. I would have to, take a look at the investments, like what the income on the investments is. I assume that they're filing taxes based on those investments. So I would look at the taxes, and we would go from there.
Terrific. Barbara has a question. She said, why don't the banks tell you ahead of time that they're selling your loan? My situation is the bank sold my loan and the new mortgage company doesn't even refinance in the state. Oops, sorry about that. The state my home is located. Now I'm stuck with high interest.
I would have to take a further look at it. There shouldn't be a reason why you can't refinance with a different bank. You don't have to refinance with the same person who's servicing your loan. I refinance other banks' loans all the time. So I would again say, if you want to reach out to me, we can, further look into it, but there shouldn't be a restriction on you being able to refinance. You're not like locked into just one person for the rest of your life.
That's very important information for sure.
Yeah, because that would be really unfair if that were true. That would,
Absolutely, absolutely. Marcella says if you have a 401k and you want to take some money without penalty, to buy your first house, what would you recommend to do? Is that something that you're
um,
in your wheelhouse?
so you have a 401k and you want to buy your first house, but you don't want to utilize the money from the 401k.
They want to utilize it they want to take some money without penalty.
Oh, that's something that they would have to speak with the person who they have the 401k with. I mean, that's a little bit out of my wheelhouse. Yeah, sorry.
Got it.
But, I mean, typically, whatever the agreement is, you're held to it, though. It's not like, but I mean, again, that's not my wheelhouse. Maybe there's a stipulation where if you're using it for, a property, you would have to definitely take a further conversation with the company that has your 401k. But
Sure.
thank you for the question.
Yeah, that was good question. Here's another question. You go. If I plan to rent out my current property and purchase another property, how the current mortgage affect the amount for pre-approval of the new mortgage? So I guess if you already have a mortgage, you're renting out your mortgage, you're renting out your home, how does that affect your new mortgage?
They're going to count it as having two mortgages. And we've done a lot of loans like that, whether it's refinance or even for a new purchase. So then your current home, I'm assuming, is your primary, and you're renting that out, and then you're going to purchase another home to use as your primary and continue renting that one. So the current primary becomes your investment property, and then the new property becomes your primary. And then we would look at your income to make sure that you have enough income to support both properties, taking into consideration the rental income. And we would need a copy of the lease, as well as seeing a bank statement showing a consistent deposit of that rent into your bank, so we can prove that that's actually occurring.
Great. Deborah wants to know, can you refinance while you are in forbearance?
So yes and no. And the reason why I say yes and no is because you have to be out of forbearance for at least 3 months in order to complete a refinance. But right now, with the volume of loans that's burdening the underwriting system for all banks, loans are taking longer than usual. So you might actually be able to start the refinance process at the same time as you stop the forbearance, and that 3 months will most likely be done by the time you close. It is cutting it close, so it's not what I recommend, but worst case scenario, that is something you could look into. But you have to make sure that you're fully caught up. You cannot do a refinance if you are in debt and you're not fully caught up.
Great, thank you. Barbara had 2 questions here. One is, what options do I have to get lower interest rate? My payoff is low also. We're talking 7% with payoff of 12,000.
So payoff,
Like,
meaning the entire debt left on the property is 12,000?
that's what it looks like. Barbara, if you want to pop in with another thing to further.
If you only owe 12,000, this is in the state of New York?
She also asked, do you refinance in Texas?
Yes, we do. We do. We're actually, that's another great point. We are in over 25 states, including Georgia, Florida, New York, Pennsylvania, New Jersey, California, Texas. So, feel free if you guys have any relatives or, second homes or investment properties. We also do commercial. So if you have any commercial properties that you're looking to, refinance or purchase, we can help you with that as well.
Great, great. And yes, it is the total amount left is 12,000.
If it's in the state of New York, I probably wouldn't recommend refinancing because the closing costs wouldn't make sense. Again, I would say, let me take a look at the mortgage statement before I make a final determination. But if all Barbara owes is $12,000, then based on mortgage tax and closing costs, it might not be worth it to refinance at this time. It also depends on how much time is left on the loan. If there's only a couple years left, then a refinance will increase the number of years. Unless Barbara wanted to look into a refinance cash out because she wanted to have extra cash on hand, then it would make sense.
Great.
So I would say, Barbara, hit me up and I could help you better.
Absolutely. And I did just share again your contact information, your phone number, and your email address.
Yep.
Nicole wants to know, and I think this is a similar question to what someone else was talking about with a home, but maybe not. Can we buy another co-op if we already have a loan for one co-op?
Depending on your income, yes. We would evaluate whether or not your income would be strong enough in order to carry the two mortgages. And if you own it free and clear, then yeah, of course, because free and clear means that you don't have a mortgage on it, which means that it wouldn't even be counted against you except for the maintenance bill. So the maintenance bill is a forever bill. So that would be counted as part of your debt owed. So when they do your debt to income ratio, the homeowners association dues for the first co-op would be included, even if it's free and clear, and the taxes as well, taxes and insurance, if they're not included in the HOA.
Terrific. Another question. Thank you, everyone. I love all these questions.
Thank you.
Steve asks, I'm retired, have a large IRA account.
Okay.
I own my co-op mortgage free.
Okay.
I free up some cash for potential foreclosure purchase if it does come up next year.
Okay.
I'd be able to get a HELOC ready.
Say that last part again about the foreclosure something.
Sure. So I'd like to free up some cash for potential to purchase a foreclosure.
Oh, to purchase a foreclosure. Okay. And you're asking if a HELOC?
Yeah, would I be able to get a HELOC ready? So maybe be able to get a HELOC
on the existing property that he has. So we don't do HELOCs as standalone. We do HELOCs as piggybacks to existing loans. So and depending on, right now, HELOC programs are floor rate of 4%, because prime right now is 3.25% with a floor rate of 4%, which means that the minimum that they'll do a HELOC at is 4%. And normally it's plus an extra percent, but right now it's plus 0 for the program that we have. I can't speak on everyone else's programs, but the program that we have. So it would be floor rate 4% plus 0. But again, we wouldn't do it as a standalone. Depending on the value of your home that you own free and clear, it might be worth it for you to look into just doing a cash out refinance on it, because I just did a cash out refinance for someone at 2.875. So that's cheaper than the 4%. And plus also a HELOC is a fluctuating rate based on prime. So when prime adjusts, so does your payment. Whereas with a refinance cash out, it's a fixed rate. So in that sense, it might be better off as well too.
Great. Wow. Everyone needs someone like you in their life. It's like, you know, these numbers and how it works. And, for all of us, most of us, I don't want to speak for everybody, but for most of us, it's an unknown, it's, and to be able to turn to you and use your expertise to figure our way through that makes the most sense is really invaluable.
Sorry, I didn't mean to interrupt. No, I was just going to say, thank you for the compliments. And I really, this is what I love. This is the part that, gets me going, and, it excites me. I love being able to look at someone's file and say, that's a good idea, but wait, what if we did it this way? And then but wait, there's also an option if we did it that way. And that's where, the fun comes in for me. And I'm sorry if I'm talking fast, and I'm sorry if, the language is unfamiliar to you, but as Elizabeth and I have discussed already, we do plan on doing more webinars in the future. So that way we can really get into the nitty gritty of certain, programs and stuff.
Yeah, absolutely. Look, this is a great overall information session that, allows some of these questions to be answered and give us all the knowledge, the general knowledge, just enough knowledge to get in trouble if we try to do it on our own. So I have another question. I have a couple more questions, if that's okay with you.
Yeah, sure, of course. Thank you.
So I'm not sure how to pronounce his first name. I'm going to say Mr. Sam.
Okay.
Again, I don't know if this is something that you can just figure out. This might be something that the two of you should discuss afterwards. But he said that he has $130,000 left on a loan with a 30-year loan at 3.75.
Okay.
If the rate goes down to 2.75 with 15 years, is that worth to do the refinance with fees of $3,500? Now that might be like a lot of.
Again, I would like to, was he actually presented this as an option? Because to go from 30-year to 15-year and drop the rate and only pay $3,500 is friggin' awesome. Tell them to put it in writing.
Right. Good point. He said, thank you. So we have a question here from Deborah. And I don't know, is Sonima a thing or is it SON?
Yes. That's a very specific program, which we do have. And again,
be refinanced. She said we're currently at 6.5%.
I believe so. I would like to see the mortgage statement so that way I could better evaluate how much she currently owes and everything else. And then we can go from there. Great.
So I'm going to put here another time in the chat function your contact info, because I think there's so many, questions that are so specific that,
yes.
gritty, that you can, you'll be able to give people another good advice. Let me ask this one more question. I want to respect your time because you've been so generous with your time.
Of course. No, thank you, everyone.
So Maricela said, do you think this is the right time to buy, or do you think home prices will go down?
Oh, wow. So
you got your crystal ball.
It depends on the area. I honestly, I think Long Island is getting super inflated right now. And I see people fighting over properties that don't truly warrant it. And I think that that's going to self-adjust in the next coming months, especially when it gets cold. Purchases tend to cease during winter. So I would, if I were a buyer looking in Long Island, I would wait until it gets colder and see, if prices start to, balance out a little bit, because I think they've gotten a little out of whack. And you don't want to be in a situation in a few years where you overpaid for a house, and then when the market settles, it's now not worth as much as you paid for it. So that's one of my concerns with all the craziness that's going on. However, if you're looking to buy in Queens or Brooklyn, the prices are dropping. So because everyone's trying to go to Long Island. So it might be a good time for you to take advantage and get some good opportunities there.
Great. That's great advice. Well, Lauren, this has been incredible. Thank you so much for your time and for your expertise. This has been eye-opening to me, and getting feedback from the attendees, it's been very helpful for them too.
Thank you.
I want to thank all of the attendees for joining us. I hope that you enjoyed this, and we'll certainly keep you up to date on future webinars that Lauren is going to do and dig deeper into all of these mortgage questions, because she is the queen of mortgages.
Thank you.
Yes, you are. So, and everyone, thank you so much. It was a wonderful time spent, and I wish you all a great day. Stay healthy, stay safe, and be well.
Be well.
Thank you. Bye-bye.
Thank you.